Okay, so in this video what I'm going to do is take you through the market cycle guidebook. This is my monthly chart book. It focuses on sort of the more slower moving medium term factors like valuations, cycle, monetary policy, has a summary view across asset classes and TAA guide and a whole bunch of charts. But what I'm going to focus specifically on is a new section here. So already had appendix here with capital market assumptions, the very standard expected return versus expected volatility scatter plot, and a table of the actual data. But I've added a couple of things which I think help just give a bit of context in terms of the lay of the land, changes, trends, and drivers or the actual components. So let's go through them one by one. So the first chart here is showing you basically the latest calculation of the expected returns versus their previous month. And the purpose of doing that is that, I think that if you're following these, it's always good to see where the changes have been month to month, and certainly this gives a flavour for that. And you can see there, just to dive into it, expected returns have come down quite a bit across risk assets, liquid alternatives there, pretty much unchanged across most of fixed income, with a notable exception. And the thing that these two here, high yield credit and EM hard dollar debt, have in common with the rest of these is that they're basically, let's face it, they're risk assets, and risk assets had a pretty good month in May, as I talked about in the May asset class returns video. I'll put a link to that if you want to see that. But basically, yeah, risk assets enjoyed a pretty good month. And what happens when risk assets rally is that valuations go up, and when valuations go up, that pulls back the valuation mean reversion factor in the expected returns. The other thing that you find is that the yield, so dividend yield for equities and REITs, etc., and then obviously also for EM sovereign high yield, as the risk premium comes down there, then the yield also comes down. So that will reduce returns just as they boosted the expected returns back in March. And speaking of that, to provide a bit more longer term context, or the trend in the expected returns, I've put these two year charts in. So I only started calculating them back in February 2019. So yeah, well, if you, we'll just have to wait around for me to build out the future months. But here's what I've got so far. And on the chart on the left here, all I've done is taken, for the black line there, is the average across all fixed income assets. So all of these ones on the right panel there. And then in the blue line, the average of all growth assets. So really everything that's not fixed income. And you can see there, well, there's a couple of things to talk about in this one. First of all fixed income has been basically trending down. So that's kind of speaks for itself. All growth assets, you can see that it actually reached quite a significant low point around the turn of the year. And then, of course, into the March crash, got a significant step up in average expected returns across growth assets, went from, I believe that's about 6% up to 12%, so almost doubled. And just to really hammer that point home, the one on the right there shows you in the blue line the prospective or forward-looking equity risk premium using the expected returns. And so that's the difference between the expected return for US large cap equities and US treasuries in the blue line there, and you can see that prospective equity risk premium had actually gone almost to -2. I think that was in January this year, and then went from -2 in January to almost +8 in March. And the grey line there, this is basically the same for global, but I've just used the equities, so MSCI, All Countries World Index, expected return minus that for the global aggregate bond index. So that the global aggregate does include not just sovereign bonds, but also, of course, corporate credit and asset-backed securities. So I guess it's quite a good sort of wider metric, because it kind of factors in some of the other alternatives there. But anyway, just give you sort of a slightly global flavour to it, and you can see there too that the gap between those two lines has been that looks about 2-3 percentage points across that time, which lines up, I guess, to if you look at the differentials between, EFI, developed ex-US, emerging frontier versus US. But anyway, I think this is going to be quite a good one to keep track of, actually. In hindsight, the contrast between forward returns, at least over a short time, was, very, very different, you know, from January versus March. So, yeah, I think that's going to be quite an interesting, useful tool by itself. Never mind how the expected returns usually get used. And the last chart here is designed to be basically a sort of condensed version, really, of that there chart, and it provides a good summary across some of the major assets there. So US equities, developed ex-US or EFI, emerging frontier commodities, global REITs, global listed infrastructure, emerging market debt, which is for this is 50-50 hard dollar and local currency. In credit, again, it's 50-50 US high yield and IG, investment grade. The global aggregate, which I just talked about, at US Treasuries and cash, and these are real returns, so taking off the long-term expected inflation. Kind of a good chart to get a lay of the land, and again, that's going to be a good one to track across time as well. And then just briefly a quick glance across to the next page. This one just shows you the main components behind global equities. And so the chart on the left here is the expected returns across the main pieces of global equities, and the red dot is the overall expected return, and then the various pieces of the bar is the components that goes into that. So looking at EM, for instance, we start with dividend yield, add on to that the expected nominal growth, add on to that the expected valuation adjustment, that's based on mean reversion, and then adding or subtracting a hedging component. You can see there for developed ex-US it's a slight positive, and for EM it's a slight negative. In both respects, the hedging premium has come down quite a lot, or discount has come down quite a lot, because you've had this really quite significant policy convergence as a result of the policy response to the pandemic. And that is how we sort of build them up. And then, of course, again, like with the previous charts, to add a bit of historical context about how those returns have evolved across time. And you can see there that US equities, even the absolute expected returns went slightly negative in January. And then, of course, you get that negative equity risk premium if you took off the expected return for treasuries there. So that's about it for there. I think that these make quite a good addition in terms of adding a bit more visibility around these expected returns, and it's probably going to be builded on and enhanced over time. So yeah, I mean, if you want to have a closer look at this report, or indeed if you want to look at how to become a client, definitely get in touch. You can probably just go to the website there, www.topdowncharts.com. At this stage, only offering it to professional institutional investors, so family offices, advisors, fund managers, hedge funds, etc. And that's it.